Barry, I'm going to start with you since you seemingly have a penchant for big headlines. And you're trying to make one now where you say the legacy of poor policy decisions risks the third bubble in 100 years. But first, a 10% correction looms by the first quarter of 2022. You really think we have a bubble brewing of epic proportions?
Yeah, there's a possibility of it. We outlined it in a note about 2 weeks ago. You know, the bubble term is misused. There have only been two in 100 years, 1929 before the crash and 1999 at the end of the year before the tech bubble crash. One is possible as you get into the second half of this year into 2023. You've got yield repression, which causes your price-earnings ratio to enter a sort of parabolic phase where it just goes straight up. The equity risk premium, as we calculated, is about 4. It could very well drop to 3 in a risk-on market if inflation and rates stay low. And you've got, as I said, real and nominal yields are very repressed. -1 on the 10-year tips, and we're negative real yields out to 30 years. So where are you going to go but stocks? And then lastly, if earnings beats start to resurge in the second half on moderating inflation but with continued growth, then yeah, you could certainly set up for a bubble scenario, which is terrible because bubbles always burst and they lead to lost decades.
Michael, what's your response to what you just heard from Barry?
Well, you know, I think there certainly could be a case made that low interest rates have really created a ramp up in assets. But I would look at it more from this perspective. I would say that low interest rates have created a situation where there are no other alternatives to invest in right now. Real estate is at a very, very high rate. And look at the 10-year Treasury. I mean, even people have been worried about inflation. 10-year Treasury is at 1.5%. So I don't know if there's really a bubble. I would just describe it as this is just where you go when the opportunity is there. If the S&P is paying 2 or 3% dividend rate and you're making 1.5% on your 10-year Treasury, you don't really have much option. The risk becomes if inflation ramps out of control. But I think that you're going to have pandemic and tax issues next year that should moderate inflation, so it's not going to be quite as high as I think many people think.
Barry, a lot of the pockets that people have been pointing to as kind of indicative of bubble activity, namely, you know, the IPO market, the SPAC market, have really come down in December and are actually underperforming. And I wonder if you still think there's a bubble when you kind of pull back the covers and look underneath and see that some of the areas that had run up so much earlier in the year have kind of come down to earth with this change and this pivot in Fed policy. Do you think that that's already happened and perhaps may have deflated some of the air that was in there?
That's certainly true. And we have been, as I said, cautious in the near term. I think we could drop in the first quarter to about 4,200 plus or minus a few percent. Because of tightening liquidity, the dollar is up, and it should tighten financial conditions. China already tightened their policy so much that they're going to impact global GDP in the first half of 2022. You've got Omicron, however mild it is, probably causing behavioral changes, and this all weakens the market. But one thing I would say, and it's a very good point you made, the SPACs and the crypto have been the repository of speculative fever. And if you recall back in 2000 at the tech bubble, it was around March that the very speculative names rolled over very sharply. And it wasn't until 6 months later the S&P fell out of bed. It was 1520.77 on the 1st of September of 2000, 6 months after NASDAQ had peaked. So you're right. The speculative issues falling may forestall that kind of bubbly action occurring later.